TCS, good numbers, bad numbers.
Well, I mean, on the stock specific, I'll have.
It's a large company. It's a large company.
I know,
so it's okay. You can talk about it.
Stock specific, I would sort of refrain. But as far as the results themselves are concerned, the results were somewhat disappointing.
Why?
For the market.
Just because there is a 0.1% miss in cross currency by TCS Infosys. All I'm trying to ask here is that if TCS management says the following line that my order book is at a record high, and order book in Q2 is 30% higher than my best order book. That's the management commentary. Infosys management commentary, our margins are at a record high. There are challenges in the short term, but what we're doing in the digital space is path breaking. I'm personally surprised with the selling which has happened in last 2 days.
No, I think beyond the stock specifics, if I was to actually put a broader commentary, is that large cap IT space is going to be one of the better performing segments of the market. Now, within which you will have different stocks at different quarters, things will happen. But if you're looking at on a 6-month horizon, that is definitely going to be one of the brighter spots of the market. So I don't know who wins the argument in that case. I guess both of you are anyway talking about the large caps. So I guess both win.
Yeah, no, maybe the disappointment came in because the market was hoping for a bit too high. But this morning, Ratnesh, we were just trying to make a point as well. I mean, IndusInd Bank has become a bit like HDFC. You can predict what it is doing. But largely, the first week of the earnings season, you would expect the good numbers to come in, and the market should be happy, and then markets will start believing that, hey, going towards the end, we'll have problems. This time around, the first 3 or 4 numbers, and I'm not even talking of the howler from DCB, which is a small name. The first 3-4 numbers, including HUL, haven't been the most impressive.
So if you look at the whole result season, by the way, result season, timetable of the result season is kind of pre-decided in the sense that same companies announced in the first week and the same companies announced in the last week, almost, pretty much. You can say 90% of the earnings timetable is almost the same. So I won't say that the companies who have better results announce faster or other way around. But the result season this season is actually not going to be a very positive result season from the market's point of view. Overall, you're looking at revenues declining, but of course, that's got something to do with oil.
But is that not already in the price? Market expects that Q2 is going to be bad any which way, right?
Yeah, so now overall earnings growth with oil, without oil, whichever way you look at it, is still going to be flattish. So previous quarter was also flattish, plus minus 2-3% here and there.
So you're saying it will be still a big dampener for the market?
Not a dampener in the sense that, you're right, it's not something beyond expectations. But if now we are looking at triggers for the market, rate cut has happened, Fed has postponed, monsoon is over, what is it that we are looking forward to over the next 1 or 2 months? So it is not going to be the earnings season. That is the summary point which I have, is that this earnings season is not the season which is going to be a trigger for the market.
Now, rather than focusing on this top line part, what the absolute growth is, should we actually look at quality of earnings? Because currency has been volatile, commodity prices have been volatile, there is an inventory gain somewhere, there is an inventory write-off somewhere, there is a commodity gain somewhere, there is a commodity write-off somewhere. So the top line actually will be deceptive. Look at the quality of numbers. Q1, there was a marked improvement in margins. Q2, there could be improvement in margins. So, okay, headline, it's a miss, but quality is okay.
So, now that we are talking earnings, let's say the year started with general expectations of again 17-18%. At that time, we had...
On that count, it's been disappointing. Yeah, acceleration has been disappointing.
I recollect we had discussions and it looked a bit optimistic. Yeah. Already you have the numbers coming down to 12-13% for the year. Probably 10 to 12% is what is the reasonable range. Yeah. But if you imagine that the first 2 quarters go by and you have 0% earnings growth, the burden on the third and the fourth quarter to deliver on that overall year's expectation is huge. So to that extent, not this quarter earnings, but next 2 quarters really become important from the point of view of whether market can hold on to that expectation that there is going to be marginal earnings recovery this year and much of that and more of that coming in the following year.
Yeah, earnings are starting to become a bit like reforms. They're not coming this quarter. ठीक है, अगले quarter आ ही जाएंगे, कोई बात नहीं. Let's just roll forward the numbers. But what's happening, Ratnesh, interestingly, is that while the larger bull market is kind of stagnated a bit, but because the markets are not cracking too badly, individual stories are making a beeline. A lot of smart moves are happening because of tie-ups, because of some order wins here and there, etc. And we're seeing a lot of smart money moving into economy-related sectors. I mean, the last 2 weeks, we've had a bunch of smart investors who've bought into infra companies, who bought into capital equipment companies, so on and so forth.
And also you have some good IPOs coming up which are getting some response.
So all of that, I mean,
Yeah.
are you okay? We'll talk about that as well. But what about the base theme, economy-related spaces, which are seeing a lot of buying of late?
So the actual alpha on a 1-year basis, 2-year basis that is going to be generated will be generated from economy-sensitive sectors, no doubt about it. I think the timing of when they start moving or when the actual variables begin to show up, that is unpredictable. It is whether it's 1 quarter later or 2 quarter later or 1 year later, but the real alpha will still be made from the economy sensitive sectors. And I think what you're looking at broader market, while that is held back by overall factors, you're right, there is enough optimism and activity which is there in whichever segments that the companies are doing well, whether it's mid caps or large caps. I think you still have, you are still in very early stages of domestic money into equities. It has already overtaken the foreign money. As and when the foreign money returns, you will have that as a added trigger. So yes, market is range bound and it's going to be range bound till some of the variables show up over the next 2-3 months. But in the meantime, I think on longer term horizon, 1 to 3 year horizon, I would still be very much positive.
So what's looking interesting right now, and a lot of cyclicals are making a comeback. We've seen a big rebound happen in metals. We were just talking to the road secretary. The government is doing a lot of groundwork and legwork in terms of infrastructure, installed road projects. Anything which is looking interesting? Railways, for instance, they as well are making a comeback, and there's been a lot of fun buying in some of the interesting stocks.
So metals, I think they're bouncing from the bottom, and I wouldn't call that space as yet interesting. Obviously, it is low value, but it is some way to go. But yes, roads and as a result, infrastructure, construction companies, I think have a long way to go. Obviously, you've had some amount of interest coming in there, but the actual activity building has just started out there in terms of first orders, then the actual construction, and then eventually showing up in P&L.
So is this the time to portfolio build, or can you get better opportunities, considering it's such a long drawn wait for you to see phenomenal returns coming in from these stocks?
No, so the infrastructure construction companies which are there, I think the good thing in roads is that now instead of them being asset heavy, now they're asset light models. So to that extent, returns are should be a little less risky in terms of growth for those companies. So yeah, right now any time is a good time to buy growth companies, and I think next 4-5 years is going to be a good time for that segment. You can never say that whether the stock will be not 15% lower after 6 months or 3 months. Those could be individual news flow variable, but on a longer term basis, it is as good as time as 6 months ago.
For those who've run a slightly consumer dominated portfolio, pharma dominated portfolio for last 3 or 4 years, they've been outperformers. Is it time now to switch lanes?
I think so, yes. It was absolutely the right strategy. Obviously, economy was floundering, global economy was floundering. Not that economy is right now buzzing, but the fact is that it is going to keep getting better and better and better. And to that extent, the defensive sectors, and mind you, the defensive sectors were also outperforming on earnings in the last 3-4 years. Next 2-3 years, they are not going to be able to outperform the market on earnings, especially if the domestic recovery kicks in. And in that case, with higher valuations that they hold, then it becomes a little bit of a risk on the defensive side. So yes, that is a strategy which could have worked in the previous few years, but I think going forward, I would be more overweight on the cyclical side of things, including banks.
So the corporate balance sheet is still very dented. Everyone is now of the view that buy into sectors like Aisha said, railways, or whether it's defense or some areas where government spending is high. Government spending has already started, but I don't see any evidence of economic pickup. We just spoke to the road secretary in the morning. He's given us numbers which are clearly indicating that the road activity is picked up. There are enough and more numbers which are floating around on what is happening in the defense sector, railway sector. Government spending is not translating into real economic activity for the private sector or earning uptick. That is my big question mark.
So, unfortunately, unlike 2002, 2003, when the recovery happened, that time the net corporate gearing was at a 10-year low. It was at I think about 10%, if I remember correct. Right now, the net corporate gearing might be at 20-year high, which is 100% or thereabouts. So you're absolutely right. It is going to take a much longer for the private sector to come back in and start following the public spending side of things. But that's unfortunately the reality, and it has to be sustained through, and it will come much slower, much later than we've seen in the previous cycle. There is absolutely no doubt about it. And at the end of the day, we also need to look at the fact that if you have low inflation and if your interest rates are going down, and historically we've been under invested as an economy in financial savings, within financial savings in equities, and there is greater and greater regulatory efforts to have less of black money in the economy. Eventually, all that is going to be good for equities. And so, yes, some of the recovery parameters will take longer to evolve. Private sector will take its own time. But there will be certain leaders who will come along the way, who will have the funding capacity and who will start to invest.
Yep. Ratnesh, afraid out of time completely, but if 15 seconds, 20 seconds, you mentioned IPOs, anything that looks interesting?
I think if you look at the overall market, the construction space looks interesting. I think some of the good quality real estate companies which have had a really horrible time over the last 5-7 years, could also be interesting areas as the economy picks up. And I think banks, and within that the PSU banks, should continue to evolve. They will obviously have bumps along the way, but that should be another segment.
So maybe the gruesome pockets could actually have a good start as well. Well, we'll save the IPO discussion for another time. Out of time completely with this discussion, but Ratnesh, thanks so much for taking the time out and joining us in our studios.
Thank you.
Thank you very much.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.